A very good evening, everybody. Welcome to the webinar Capturing Trading Opportunities in Rising US Interest Rates. I'm Ming Hui from Fluid Futures, and speaking to us today will be Mr. Thomas Poh, founder and director of PZH Consultants. He will be discussing the correlation between the Micro Treasury Yield Futures and the US interest rates, as well as how you can capture potential trading opportunities. Before I pass this on to the speaker, please be reminded that if you have any questions throughout the course of the webinar, you can drop them into the questions box and we will answer them during the live Q&A session towards the end. And now, without further ado, let's have Thomas speak to us.
Hi, thank you, Ming Hui, for your introduction, and big welcome to everybody for taking the time to attend today's webinar, proudly brought to you by CME Group and Fluid Futures. Okay, I'm Thomas Poh. I've been in the financial market for over the last 20 over years, working in various MNC banks and even in the based abroad in places even like Vietnam. My focus is in FX and interest rate derivatives. Okay, so before I proceed, maybe just a quick introduction of my company, PZH. Okay, I founded PZH Consultants, and we are focused on these. So we are focused on product training, skill set training, and transformation consultancy. All right, and just a quick reminder. Whatever I say today is purely for training and education purposes only, and they are all my personal view. Okay, so without further ado, what are we going to cover today? I have brought to you today a very short agenda. Okay, I'm going to introduce to everybody micro US Treasury futures. Okay, you may ask what it is, and hopefully after this session, everybody will have a better understanding on how to use it to trade interest rate. Okay, and after that, I'm going to share with you a little bit of my insight into how I see the US interest rate market going forward. Last but not least, I'm going to share with everybody some useful CME online tools. Okay, so let's begin. But before we talk about trading of micro USD's futures, right? Somebody may ask me, you may ask, why futures? Because a lot of us here as private investors, and maybe you do a little bit of day trading, you would have exposure and maybe understanding predominantly in stocks, in ETFs. Okay, so maybe futures is something that you would have learned in school, but not too sure why should we be even including this into our arsenal of trading tools. Well, first and foremost, trading of futures involve zero default risk, and as we have known since the 2008 Lehman crisis, I mean, default risk is something that could not be understated. Okay, so that's first. Second, liquidity. Right, CME Group's futures are highly liquid, and as investors, as traders, okay, liquidity is very important to us, especially to us retail investors. All right, and because it trades through the exchange, pertinent information such as trading volume, open interest are duly available to everybody on a level playing ground. Okay, so high transparency is a third advantage. Leverage. Okay, as you have maybe understood by now, the trading of futures does not allow us, or rather does not require us to put the entire notional amount up front. Okay, there's a certain leverage, in fact quite a high element of leverage involved with trade futures. Longer trading hours. Okay, I cannot understate this, because during my time as a traders working those in the banks, a lot of time events happen at the most unpredictable timing. Okay, usually is before market opens, and if you have, for example, you have invested in US stock market, right, and an unforeseen event has occurred, you might have to wait until the US stock market open before you can do any hedging, or you have to manage a position, or to take advantage of that opportunity. Okay, the longer trading hours which futures provide, and it's close to 24 hours. In fact, it's around 23 hours per day. Okay, that longer trading hours allow you to take advantage and make your risk management decisions on a very timely manner. And you put all this that we have mentioned together, the trading, the ability to trade futures, okay, adding futures into your trading repertoire, okay, allows you to really have a complete suite of risk management tools. Why? All right, imagine a situation like COVID, right, where events are very dynamic. In 2020, events get unfolded, round the clock, right? If you have participated in the futures market, that would allow you to react and manage accordingly, rather than take on a more passive stance and wait for the traditional stock market to open. All right, so that is a quick reminder to everybody here, the advantage of trading futures. Okay, so now to today's topic. Today's topic is about US Treasury futures. How are we going to capture trading opportunity in the rising US Treasuries, rising US interest rate? Okay. As a trader, I cannot emphasize enough the importance of monitoring interest rates. Why? Because interest rate directly or indirectly drives all classes of economic activities, from the basic, manufacturing, to credit markets, property market, stock market, commodities, up to foreign exchange. All right. So if you ask me if there's one single financial market parameter that really drives all asset classes that we can think of, I will pick interest rates. Now, okay, a few things comes to mind now. All right. Traditionally, the market trades US Treasury futures. Okay. First of all, the ability to trade futures allow you to short the bonds. That means that you can capitalize on a rising US interest rate environment. But traditionally, the trading of US Treasury futures, all right, which covers things like the 2-year T-note, 3 years T-note, 5 years T-note, okay, 10 years, ultra 10 years, classic T-bond, and all the way to the ultra T-bond. We're talking about the 30 years US Treasury as underlying assets. Okay, traditionally, the trading of such US Treasury futures, right, falls into what we call financial institutions turf. Okay, usually it's the domain of financial institutions. Okay, so these are the following list of traditional CME US Treasury futures. Okay, as mentioned earlier, it spans from 2 years all the way to ultra T-bond. Right. Okay. As we know, futures, US Treasury futures, they are underlying all US Treasuries. Okay, so that's great. Okay, we all understand that. And as a quick refresher, as interest rate rise, bond prices drops. Okay, we know that. So when we trade US Treasury futures, the traditional US Treasury futures, if we think that interest rate is going to rise, like something like the current scenario, usually we'll short the futures. Okay, so first of all, the direction is opposite. So if you think that interest rate is going to go up, you will short the futures. Okay, so that is something that we have to keep in mind for traditional US Treasury futures. But there's additional complication when we talk about the trading of US Treasury futures. Why? Because the quoting convention, the quoting convention of US Treasury futures follow what we call the cash market, which is the actual physical US Treasury market, right? And they are quoted as a percentage of par Okay, so the treasuries themselves quote as a percentage of par, so the futures quote as a percentage of par, plus they quote in terms of fraction. Why? Because prior to the time of computers, because this market actually started, I think at the turn of the century or even longer, right? So there wasn't many computers at that time. Computers were not invented, so it was easier for traders to use fractions. Okay, so that resulted in the treasury cash market quoted in terms of fractions, and the futures of the US Treasury market also quote in fraction. And as I said earlier, the US Treasury futures and cash market both quote as a percentage to par. So why is this a complication for the everyday trader? Why do I mention that? Because think about it this way. If I ask anybody, the screen here, 118.20, and that's the price quoted for this particular bond or this particular treasury or this particular futures, that's the price that's quoted. What's the equivalent yield? Right? It's not so easily understandable. Okay. And as we know, when we track interest rate, we track it in terms of the actual yield. Okay, US Treasury interest rate 1.22%, as in this screenshot from Bloomberg TV shows. Okay, it's not as intuitive if we want to track the actual interest rate market via cash US Treasury prices or traditional US Treasury futures prices. Okay, because it's not quoted in yield. We have to do some calculation and do some conversion, and that's something that you can do easily offhand. Okay, there's one more complication when we talk about the traditional CME Treasury futures market, and that has to do with the nature of the future itself. And what do I mean? Because futures involve two ways of settlement come maturity. Two ways. Okay, the first way is you can have physical settlement. Right, physical settlement actually means that come the contract maturity of the future, right, the seller will have to will get the right to choose to deliver the underlying asset, and the buyer will pay for it. Okay, that's what we mean like physical settlement. So markets like the crude oil futures, gold futures, they are typically physical settlement. The alternative is cash settlement. Okay, so why is this the complication and why did I bring this up? Because traditionally, CME US Treasury futures, they are physical settlement. All right, so they are physically settled. Come maturity, each of these contracts has a what we call a basket of US Treasury that qualifies for delivery. Okay, so come maturity is not just one single US Treasury. So there's an added complication rate. There is a basket of deliverable US Treasury futures that commensurate to that particular US Treasury futures. For example, right, I bring your attention to say the 10 years. Okay, so everybody say 10 years is the bellwether. So we'll look at 10 years yield, we take the 10-year futures, but not everybody knows or realize that the US Treasury 10-year US Treasury futures, the deliverable US Treasury is actually falls within a basket of 6.5 to 10 years maturity. Okay, and the seller has the right to decide. Okay, and then you have to understand theories like what we call cheapest to delivery, conversion factor, etc., etc. Now, you put all those I would say, technical complications, that is something that I would say a lot of retail clients may not be able to understand. Okay, in fact, some professional traders, especially when the young traders that came into the market, it takes some time for them to really go through the motions and understand the mechanisms behind this market. So for retail clients, we can really empathize that it's not something that's easily, appreciated by retail clients. And that's the reason why traditionally the US Treasury futures market comprised mainly of financial institutions, the hedge funds, asset managers, market makers like the banks. Okay, but that said, okay, as I started this session earlier, I reminded everybody the importance of tracking interest rate, because that is one financial market parameter that really moves and shakes all asset classes that we think of. And that's the very reason why CME launched this new suite of products called Micro Treasury Yield Futures on the 16th of August this year. Okay, so it comprises of the 2 years, 5 years, 10 years, and 30 years Treasury Yield Futures. Okay, so each of them corresponds to a particular tenor: 2 year, 5 year, 10 years, and 30 years. And these are some of the highlights of the futures details. Okay, first and foremost, I draw your attention of the size. Okay, $10 DVO1. I'll explain to everybody what DVO1 means later. Okay, but as you can see here, the price per tick is only $1 US, and it's financially settled, so you don't have to worry about physical delivery. So you put that all together, it really, this suite of product is really a customized, interest rate trading product that was designed for the retail client. Okay, so I'm going to spend the next 10 minutes or so explaining to everybody how does this work. Okay, this itself is slightly different from the traditional CME Treasury futures. Okay, so if you guys want to know more, you can actually look at go to the website by CME Group, and they're all listed down there. Okay, so first of all, the trading direction. Okay, the trading direction. Right. Earlier, when we said when we trade the traditional US Treasury yield future, US Treasury futures, if you think interest rate goes up, you sell the futures. Okay. Well, this is not too difficult for people to remember. For these micro yield futures, okay, because you trade on yield, right? You're not trading on bond prices now. You trade on yield. For example, if you think that the 10-year yield is going to go up, like it has been doing for the last 2-3 weeks, okay, you typically go long. Okay, so if you think interest rate go up, just go long. If you think interest rate is going to crash, you go short. It's as simple as that. It's a lot more intuitive. Okay, the next thing I have to share with everybody is this concept called basis point. Okay, so when we trade interest rate, okay, we talk about basis point. Basis point is just means 0.01%. So that's 1 basis point. Okay, for example, if interest rate is 1.21 and it goes up to 1.22, interest rate went up by 1 basis point. Okay, so for this particular micro yield futures, the minimum price fluctuation is not even 1 basis point, it's 0.1 basis point. So it's 0.001. Okay, so for example, it goes up from 1.201 to 1.202. Okay, it went up by 0.1 basis point. And if you notice, I highlight this $10 DVO1 in yellow. Okay, I said earlier I'm going to explain to you. I'm going to do it right now. When we look at contract size here, we're actually looking at how much your profit and loss move if interest rate goes up by 1 basis point or go down by 1 basis point. So in this particular case, if interest rate goes up by 1 basis point, okay, your profit and loss is $10. That's what it means by 10 DV1. So for every contract, if interest rate went up by 1 basis point, your profit will be $10. So in this particular case, if interest rate went up by 0.1 basis point, which is the minimum price fluctuation, and your long one contract, you will have just made $1. Okay, it is deliberately designed so that it caters to the retail traders, investors like you and me. Okay, so I repeat again, dollar value per basis point, DVO1 per contract is $10. So for example, if interest rate goes up from 121 to 122, as I said earlier, it went up by 1 basis point. And if you're a long one contract, you have made $10. Okay, so you may ask, right, we are trading yields. Okay, you say 2 years, 5 years, 10 years, 30 years. What exactly are these yields referring to? Okay, they are what we call US Treasury OTR benchmark yield. What does OTR means? Well, OTR means on the run. Okay, OTR means on the run. So they are the newly issued, okay, US Treasury of that particular tenor, and they are so usually once a new Treasury get issued for that particular tenor, that Treasury issue becomes that particular tenors on the run, because as we know, the US Treasury, the US government is they issue a lot of debt, okay, and that's done through the Treasury. So there is a constant supply of new issuances with different details in terms of coupon, in terms of maturity, and every time that gets issued, it becomes the new OTR, and that becomes the US Treasury benchmark for that particular time. All right. Okay, and that is also one advantage of trading US micro yield futures, because you will be effectively trading the OTR benchmark yield all the time. Okay. Now, the next thing we have to talk about is the maturity months. Okay, so for the maturity months of the micro yield futures, it is listed as the closest 2 months. Okay, so for example, when this contract was first launched, the August and September contract was available for trading. Okay, and the last trading day of each contract is the last business day of that particular trading month. So for the August, it will be 31st, okay, and you'll be 30th for the Settable contract. All right, okay, so what happens come maturity? What actually happens come maturity? All right, and we said earlier it was all the contracts for micro yield futures are financially settled, unlike the traditional treasury futures. They are physical settlement. So what happens is that it will use the US Treasury benchmark as published by BrokerTech. Okay, BrokerTech, and that BrokerTech is administrator. Okay, that is published on the CME Group website. Okay, so the actual yield is calculated using actual trades executed within a 15-minute window, leading up to 3 p.m. fixing time for that particular day. All right, so it's financially settled, and it uses the actual, trade weighted, right, volume weighted yield of all the traded the trades of that day. Okay, so I'm going to walk you through a quick example on how this financial settlement actually work. Okay, for example, using the August contract. Okay, using the August contract, we have a 10-year, Okay, so you are long 5 contracts of the 10-year micro yield futures. All right. Okay, so what happens is that if let's assume that the 30th August settlement price is 1.22%. Okay, and that is have already been used to mark to market your position the day before, which is the 30th. Okay, so come maturity, come settlement, final settlement on the 31st August, if you have not closed your position, you have outstanding position, that contract will be settled using the fixing price. In this particular case, I use an example of 1.28%. All right. So the net settlement amount will be 1.28% minus 1.22. Okay, that gives you 6 basis points. Multiply by the risk of each contract, which is the contract size. And I said earlier many times, is $10 per basis point. So that's $10 times the number of basis points you actually made across the 2 days, and which is 5. So you have made $300 profit. Okay, so it's as simple as that. Okay, as simple as direct as that. And as a gentle reminder, okay, because of the mark-to-market process, okay, your margins posted with the exchange through the brokers will have adjusted on the daily basis, right? And that is the reason why, right, your cash flow will be only the difference between the 30th and 31st prices. Okay, that's just a quick reminder. Right. So these are the summary of the 4 contracts that I have mentioned earlier. And you have noticed that, hey, the contract size are all the same, right? They are all 10 DV01, regardless whether you are trading the 2 years, 5 years, 10 years, or 30 years. Okay. And why did I remind everybody that? Okay, there's this big advantage when the contract size is the same for all the 4 tenors that's listed. Why? Because a lot of times when we trade interest rate, right, it's not just about directional. Okay, we trade curve. Okay, the yield curve. Right. For example, if you have a view that the yield curve is going to steepen, so the 2-year versus the 10 years, so the yield curve, so the 10-year interest rate, you think that it's going to go higher or faster than the 2 years interest rate, or the 2-year interest rate will come off and the 10-year interest rate goes up. That is a yield curve steepening trade. You would just simply short the 2 years and long the 10 years with a ratio of 1:1. And this is a big advantage when we talk about micro yield curve, micro yield futures versus traditional treasury futures. Because for traditional treasury futures, you would need to calculate what we call the hedge ratio, so that you have no directional risk. For micro yield futures, you don't have this problem. You don't have this challenge. It's always 1:1. Similarly, if you think the other way around, if the curve is going to flatten, for example, in this particular case, a 5 versus 10 years. Okay, you think that 10 years interest rate is going to come off faster than the 5-year interest rate, or the 30 years interest rate is going to come off faster than the 5 years interest rate, or the 30-year interest rate is going to go up slower than the 5-year interest rate. Then you have a curve flattening treasury where you long the 5 years and you short the 30 years. Okay, so because your ratio is always 1:1, okay, it's also very easy to calculate your P&L, right? To understand how your P&L risk profile is. So if this yield curve trade that you have go out by 1 basis point, for example, the 2 versus 10 years steepen from 100 to 110 basis point, okay, and you have your long 1 10 years and short 1 2 years contract, then your profit and loss is basically you are in the money by $10. It's as simple as that. Okay, that's the beauty of micro yield futures. All right. Okay, so that's a espresso session for everybody. If you wish to understand more, you can go to the website by on CME Group's website to understand more. Now that everybody have a feel, okay, I believe that everybody agree with me that understanding interest rate, monitoring interest rate, and trading interest rate is potentially a very important, tool in our trading arsenal. So let's talk about what is the market is focusing on going forward in the next, say, 3 to 18 months. Okay, in my personal view, right, I think they will hover around these four main themes: inflation, okay, what the US Federal Reserve is going to do about that, the pandemic, the evolutions, the variants, and also, keeping track of the US versus China tensions. Okay, so for the next few slides, I'm going to share with you some snippets of how I see the market going forward. Again, I would like to emphasize these are purely my personal opinion. Okay, as traders, we all need to form our own views. Okay, it's great to hear what other think, but end of the day, you have to form your own view and trade your own view. So inflation, right? This is a chart of US CPI numbers versus the Fed funds rate. All right. So the biggest question that is hovering, or rather the biggest topic that's in the financial market now is inflation, right? Initially the Fed thinks that inflation is transitory, right? Now they think that because of supply concern, we may stay higher longer than they wish. Okay, so that's something to keep note of. And why is that important? Because if you look all the way back to 1955, the Fed funds rate, which is based on the decision of the FOMC, the Federal Reserve, okay, they have never been too far behind the US CPI numbers. Okay, so keep that in mind. This is something that I'm sharing with everybody. Okay, focus on it. The next is because of that. Okay, the next hottest topic in town is tapering. Okay, tapering. What is the Fed and the other central banks are going to do? Okay, we have to be able to decipher their language in terms of the minutes they publish during the meetings. Okay, so based on the last meeting, I think the Chairman Powell himself has already hinted that, come the next meeting, I think they will be prepared to give a timeline in terms of a schedule, in terms of how the Fed is going to taper, right? A quick reminder for those that need a refresher: tapering, basically because of the pandemic, the Federal Reserve bought a lot of US Treasuries and mortgage-backed loans and put it onto the balance sheet, okay, to rejuvenate the economy. So as inflation measures pick up, they are now thinking to reduce these purchases size, the size of these purchases. Okay, so this is something to keep track of. Come the next announcement, all right, next meeting, what the announcement, what the schedule is going to be. But that said, my personal opinion is be careful, because tapering does not mean hiking. These are two different discussions altogether. They do not get carried away just because that the Fed announces or going to announce their schedule, their tapering schedule, that they are on the verge of interest rate hike, because a lot of people, market tends to get carried away. Okay, so I'd like to remind everybody on another announcement that the Fed has made last year, okay, 27 August. So basically they say that they have moved to inflation average inflation targeting and no preemptive rate hike due to low unemployment figures. So the message they had sent 1 year ago was that they will err on the side of caution, say lower for longer than necessary. I think that is the message. So market will tend to get carried away, and we'll come back to that being carried away phenomena later. Okay, so bear that in mind, there is the tapering schedule and there is a rate hike expectation, and that is two separate discussions altogether. Okay, and one of the things that the Fed actually watched very closely is payrolls, employment, right? Okay, and this is a chart of the US non-agricultural, non-farm payrolls, non-agricultural new hiring numbers every month since the outbreak of the pandemic. Okay, as you can see here, there was a historical drop of 20 over million. Okay, 20 over million since the outbreak. Okay, so I have to basically zoom in on the numbers after that fateful month in April, because the scale of it would have misrepresented the recovery, pace of the recovery. So this is how it looks like since the big drop. Okay, so as you can see, there was a big knee-jerk recovery, and then numbers seems to be, especially the last couple of months, seems to point to that it's recovery stalling. Okay, this is still, the jury is still out on that. Okay, my personal view is that perhaps not. So good that it's important that everybody also track that number if you have not already been doing so. All right. So the next thing I want to share is, we talk about trading of interest rates. Okay, let's look at how interest rate, and look at the bellwether. Okay, let's look at the bellwether, which is the 10-year Treasury yield. All right, the 10-year Treasury yield movement since the outbreak of the pandemic. Just to give you an illustration, the opportunities that is out there in terms of trading interest rate, because everybody look at stock market. All right, I think for retail investors, everybody track the stock market and say, oh, okay, Nasdaq, S&P 500, fine, right? But interest rate is something that not all retail traders look at. So this is just to share with you the opportunities that's out there if you are conversant with the products that's available, in this case micro yield futures, and the market movement. Okay, so since the outbreak, yields collapse. Okay, we know that yields collapse. Okay, we know that. Why? Because of flight to quality, right, and expectation that the Fed is going to cut interest rate. But if you notice that after that, there was a big spike in interest rate. Oh, that's counterintuitive, because at this point of time, this March, the crisis was running red hot. Okay, it was the global financial markets was staring at the abyss. Why the interest rate spiked rather than continue to go south? Because the reason is because due to the fact that the pandemic drove everybody to hoard US dollars. There was a big dollar demand, a surge in dollar demand that resulted in everybody selling assets to raise US dollar cash. So interest rate spiked instead of continuing south. Only when the Fed came in and announced quantitative easing to the infinity, right, unlimited QE, that interest rates start going normalized again and start going down again. And then come the mid of last year, okay, as the pandemic, the world got its grip on how to handle the pandemic, then the science of the vaccines research, breakthrough in vaccine research. Okay, then you see the next team playing, which is recovery, and then even driving into inflation. Interesting enough, okay, as everybody expect interest rates to go to the moon, okay, you start going south again, because then that is when people start thinking, hey, maybe we have overdone, and everybody is, I think a lot of it has to do with positioning, right? The market is basically too short treasuries, right? Everybody expected treasuries to go higher, all right, and then the Fed start giving some dovish talks, all right, market adjusted again. Then now we are at the later stage. Okay, this is where you see that the US Treasury, right, the US Treasury, okay, they have the yields have rebounded, and that's partly due with the fact that inflation pressures persisted. Okay, and the Fed had given out everybody some guidance on their tapering schedule, which is going to be announced, I think, the next meeting. But if you look at a long-term interest rate, right? If you look at a long-term interest rate, okay, to me, if you look all the way back to post Paul Volcker days in the 90s, US Treasury interest rate has been on a downward trend. Okay, has been on a downward trend. Okay, and I personally think that the resistance is actually at 2%. Okay, but feel free to draw your own conclusion. Now, talking about trading US Treasury yields, we said earlier about yield curve. Okay, it's not about just trading about direction. Okay, US Treasury yield curve is very volatile per se. Okay, look at how the yield curve is in September 2019. It's inverted at that point of time, and then it normalized again. Okay, as the market expected the Fed to cut interest rate, and they did. Okay, December 2019, and then when the pandemic hits, okay, it shift lower and it went inverted again as the market expected the Fed to cut interest rate down the road, and then it normalized again. So you see how even the yield curve itself is volatile and gives you a lot of trading opportunity. That is why if you use the micro yield futures, it really gives you a big advantage in terms to try to capture to express this trade strategy, because if you have the ratio is always 1:1. Okay, that really simplifies a lot of things. All right. Okay. So the final part of my segment that I want to share with everybody today is some useful CME analytical tools. Okay, I'm going to just share with you two. One of them, we talk about monitoring the Fed, right? The Federal Reserve, FOMC. Okay, a lot of times we hear in the news, all right, the market has priced in this probability that they're going to hike the interest rate by this meeting down the road. How they actually put up this data, that's actually done via the Fed Fund futures, and CME have a free analytical tool that is listed on their website. Okay, you can Google CME Fed Watch tool that uses the actual futures prices of the Fed Fund futures, right? And these are actual market prices. These are not economy survey. They are basically where the market put the money where the mouth is. So based on these prices, this tool is able to extract and calculate for you what the market thinks the probability of a potential Fed hike or a cut in any particular meeting. All right, and you can see here it stretches all the way to February 2023. That's how far this tool allows you to see what the market thinks. Okay, and you can look at it in different angles, different perspective. You can look in terms of beating probabilities. Okay, and you can even look at in terms of total probability. And this is really what the commentators actually refers to when they say the market has priced in a 50% rate high, a 40% rate high, etc. Okay, and you can also see we saw as what a lot of the commentary says, dot plot. Dot plot is basically a reflection on each governor's view of how they see the Fed funds trajectory in the future. Okay, so you can see each dot represent one particular governor's view. All right. Okay, so this is the CME Fed Watch tool. Okay, I highly urge everybody to go to the website and take a look if you have not done it before. Okay, it is really a very powerful tool that even professional like myself use when I was trading for the banks. Okay, the last tool I would like to share with everybody is a Treasury Watch tool, because what we're doing here, we're trading US Treasury yields. So this Treasury Watch tool allows you to analyze all the pertinent, important information, all the relevant Treasury information that relates to that market on one single site. Okay, you have here the Fed Watch tool result, which I shared with you earlier. Okay, US Treasury issuance calendar, for example, economic announcement dates, Fed balance sheet, and now that we talk about tapering, the ability to track the changes to the Fed balance sheet. I think that is a very important tool. All right, needless to say. Okay, feel free to explore and play around the tool. They are all free on CME Group's website. Okay, so to summarize, Micro Treasury Yield Futures. They cover 2 years, 5 years, 10 years, 30 years. These are their codes. Okay. They all are trading on a much smaller size as compared to traditional Treasury futures. Okay. Per basis point per contract is 10 US dollars. They all track the underlying on the run benchmark Treasury yield. Okay. They track in yields, so you don't have to backward calculate what yield correspond to what prices as you need to for the traditional US Treasury futures, and they are all financially settled. Okay, so there's no worry about the setting up facilities to take delivery of the actual physical US Treasury come maturity. Okay, right. So there's a quick summary for you of what we have covered today. For those that would like to understand more about CME Group's products, research, okay, and the tools, you can also either go to the website shown here, or you can download their app. Okay. Oops, sorry. Okay, or you can download the app. All right. Okay. Okay, so all the tools that I mentioned earlier, they are all available on the app as mentioned. Okay, and last but not least, there's also a fresh from the trading room publication. I think that is published weekly. It's also available on the CME website. Okay, so they will share with you some of the themes that's going on in the market. All right, so thank you very much everybody for your time, and if you want to follow me, this is my company's QR code. This is if you scan this QR code, it will lead you directly to the comments page. Feel free to leave any comments or connect with me via LinkedIn, or drop me an email with any specific questions to ask. Okay, so I have come to the end of my webinar today, and we still have some time. We'll do a quick Q&A. Okay, I already see some of you have listed quite a few questions. So allow me to scroll through them before I pick some of them to answer. But before we even go there, right, Ming Hui and I have prepared a short poll for everybody to participate. I urge everybody to participate, and I'll explain to you why later. Okay, all right. So the poll is this. Okay, it's a straw poll because we talk about the trading of US Treasury futures yield. Okay, so the poll is going to ask you, what do you think personally is going to be the 10 years, which is the bellwether, 10-year US Treasury yield come the end of 2021. Okay, come the end of 2021. So feel free to participate. I urge everybody to do so. Okay, so Ming Hui, can I pass the mic to you for now, while and explain to everybody how to do the poll?
Sure. Yep. So everyone, you can just put in your responses, and we will close it in about 10 seconds. In the meantime, you can also send in some questions you may have for Thomas, and he will address them afterwards. Yep, I think we're good. We will close the poll now. All right. And
Maybe let's not share the result yet. Maybe we do the Q&A first.
Sure. Yep.
Okay. So thanks. Thank you everybody for joining the poll. Okay, great. I think I have some questions, very good questions here. Somebody asked this: is liquidity risk something to consider when trading futures? All right. Would the use of longer tenors above 10 years will have a wider bid-ask spread? That's a very good question, and especially for retail traders, liquidity, right? I mentioned earlier, liquidity is very important because, let's put it this way, we are small fries here compared to the big financial institution out there. The good news is, okay, I'm glad to share with everybody, for micro yield futures, the liquidity, and we measure liquidity strictly in terms of bid-ask spread, which means that what is the price between buy and sell. The tighter it is, the more liquid it is. Okay, so so what happens here is that during Asian time zone, the bid-ask spread for 2, 5, 10, and 30 years micro yield futures is 1 basis point. Okay, that's my understanding that I know. Come US time zone, okay, once the US main market opens, it becomes 0.1 basis point, which is the minimum price fluctuation. Okay, so back to your question, liquidity is important, but it's not a concern for the micro yield futures market, even though it has only started in August. Okay, so that's the good news. Okay, right. Somebody asked, is duration risk another element to consider in trading US Treasury futures? Okay, yes, of course. I mean, duration. Okay, for those that is not too clear, duration is one way to measure. Is the way we measure risk when it comes to interest rate trading. Okay, so and DVO1 is a measure of duration. Okay, so the way the contract has been designed is already talking about risk. Okay, as compared to say by notional amount, then you have to start calculating. Okay, if I have a notional amount of 100,000, which is what a 10-year traditional CME future is worth. Okay, 100,000 US. How much profit and loss I have if market move by 1 basis point? Okay, so you have to do that mental calculation in your mind straight away. When I was a trader in a trading floor, right, we do that all the time. Okay, so it's not as intuitive if you are a newbie. Not an issue when you trade for micro yield futures, because it's defined as DVO1. We use duration as the we use the risk. We use the risk as the contract size. Okay. All right. Somebody actually asked, what's the 10-year interest rate right now? All right, it's around 1.65% for 10 years. Okay. Okay. I'm still going through. Okay, some of the questions asked here are regards to operational stuff. Ming Hui, are you able to answer things? Some of the questions. Okay, some of the question is about the price sending from Malaysia to Singapore. Do you have a comment on that?
I'm not able to answer that, but we will address all these admin questions after the webinar.
Okay, sure, cool. All right. Okay, maybe Ming Hui, I think we are running a little bit low on time. Maybe it's a good time for you to share the results of the poll.
Sure, hang on. Yeah.
Okay. Right, let's see. Okay, Ming Hui, everybody can see the results here, right?
Yes, they can see the results.
Okay, so right. Okay, so we have quite an even distribution, I must say. Okay, quite an even distribution in terms of what everybody thinks of the US 10-year yield come the year end. All right, come the year end. Okay, the reason why I brought this up is I had maybe Ming Hui, can we go back to most of the people actually hovers between 1.5 to 2%, which is around current levels. Okay, maybe you can end and share the poll results. Okay, so we are back to my slide, right?
Yes, we're back to you.
Okay, so the reason why I did that was to me, I think this is a very interesting activity to us because I think we have quite a big audience here. Earlier this year, in March, 2021 this year, March 2021 this year, which is around this time, I made a similar poll. I conducted a similar event, okay, on US Treasury interest rates. Okay, at that time it's not about micro yield futures because it was not launched yet, but it was more for financial institution, and we were talking about interest rates. And I asked everybody the same question. Okay, close to, I think 70% of the people stated that interest rate will be above 1.7% come year end. All right, and we were actually here in terms of time, here in terms of yield. Okay, so at that time when I asked everybody thinks that interest rate yields is going to go to the moon, and that's one reason why I was not too surprised when interest rates start crashing. Right, that's why you get to love, you have to love the financial markets, because it does such things to you, right? When all the information has been priced in, all the information has been digested, when all the bases are loaded and everybody's on one side of the market, right? The market really has a habit of shooting itself on its foot, and that's the reason why there was a lot what we call position adjustment, also known as stop losses, that go through, because everybody was already have the view and position that interest will go up. Okay, so I thought this time around maybe I should ask, what does people think? Okay, so this time, based on the answers given, is quite, more diversified, more spread out as compared to previous time. So maybe, yeah, just based on that, maybe interest rate does have legs to continue to go up, because not everybody is short treasuries or long micro yield futures already. Okay, so on that note, I thank everybody so much. Okay, thank you for your time, and thank you, Ming Hui, for your effort to put this all together. Again, if anybody want to follow me, right? Okay, you can catch me on LinkedIn. Okay, catch me on LinkedIn, or you can go to my website and drop me a few words on my comment wall. Okay, thank you so much. Back to you, Ming Hui. Everybody have a nice evening. Stay safe and stay healthy.
All right, thank you for that, Thomas. For the questions we couldn't get to tonight due to the time constraint, we will respond to them via email. This was a very insightful session, so thank you again, Thomas, and thank you very much, everybody, for your time tuning into this webinar tonight. We'll be sending everyone a link to today's webinar recording, so you can watch it again if you'd like to. And that's all for today. Thank you, everyone, and good night.